Welcome to Eurodollar University. Dear audience, after this show, you'll be able to go to your local sauna or steam room, sit down, take off your towel, and say, ladies, you won't believe this, but the Federal Reserve is about to pivot. Yes, that's true, ladies and gentlemen. We're going to be talking about the 2-year forward rate, implied rate, versus the 2-year cash rate. Jeff, what an introduction. Are we going to lose any audience members? I don't think so. I think we're going to gain them. We're going to be reading from an article that you called Forward Pivot, and it is not available to the public unless they go and sign up somewhere. But in this article, you're going to tell us a new measure. You've never revealed this one before on how to know when the Fed is going to go from rate hike to where the market is expecting they're going to go, which is rate cut. Tell us where the audience can find this article.
Well, now that you've sold the article or oversold the article, it's at Markets Insider Pro, which is www.marketsinsiderpro.com. And it's free of charge for now. You sign up with your email. You get access to all that information. There's a daily briefing I put out, as well as these deep dive articles into some of these topics, money and macro topics. You know, Steve Van Meter's got some momentum timing strategies for you. Tracy Schuchart, some insights into the oil and gas market. So that's at marketsinsiderpro.com. And yes, we're going to talk about the 2-year forward fitted rate. And I love how in the title, because the official title of this particular calculation, the end of the title is hence.
Tell us why. Why do you love that?
I have no idea. I don't know. I've read the original paper as well as the follow-up, and why do they call it 2-year forward hence? It just seems like sort of a nerdy way to advertise this one constructed measure, for example.
The fitted instantaneous forward 2 years hence.
Yes.
The fifth twos is what they're called.
It seems
Jeff,
like, then the other explanation could be it's just overly complicated because that's what econometrics and economics does. They overly complicate what should really be a very simple concept, because the forward 2-year is pretty a simple concept. You're looking at the yield curve and saying, what does the market expect the 2-year rate to be a couple years down the road, or a year down the road, or whatever it happens to be, whatever a future look back period is.
Now, Jeff, we have talked about inversions forever on the show. We've done a number of shows on them. We've discussed the 10-year versus the 2-year spread inversion, the 10-year versus the 3-month inversion, the Eurodollar futures inversion. Let's first do some fundamentals here. Why are we just going to be focusing on the 2-year here? Why is the 2-year important? And we'll talk about the 2 flavors of the 2-year in a second.
Well, out of all the coupon bonds, so these are not bills. Bills are actually, there's no more certificates of indebtedness, which are short-term, which used to be short-term instruments that paid a coupon. Now we only have treasury bills, which are issued at discounts, which means you don't really get an interest rate. You get a full you pay less and get the full price at the end of the maturity.
You don't get a coupon. You
right.
do have an interest rate issue.
It's an implied interest rate there because it's not actually an interest payment. You get reimbursed for whatever the discount was.
Okay.
Whereas the 2-year note is the first of the notes that are first of the coupons that is actually closest to a money equivalent. And there's a lot of different things that go into that. You know, Manmohan Singh from the IMF has talked about how the 2-year note is perhaps the best or the least frictioned instrument for collateral. So there's there's moneyness in the 2-year notes that isn't apparent in some of the rest for obvious reasons. I mean, the 10-year, for example, as we talk about all the time, growth and inflation expectations basically overwhelm any of the moneyness in that. Not that there isn't, especially when related to on-the-run 10-year treasuries and collateral use there. But the 2-year note is the closest thing to money-like behavior, money-like attributes in the coupon payments or in the coupon section.
Okay, so the spread between the 10-year and the 2-year can be thought of as an early warning indicator. Recession ahead, trouble, maybe not recession, trouble, economic disorder, monetary danger ahead. the spread between the 10-year and the 3-month can be considered brace for impact, imminent collision. What about this 2-year forward and 2-year, what is the cash rate? What is that going to tell us? What is that indicative of?
It's basically where the market is implying where the 2-year rate's going to be. So if the 2-year is the most money-like of all of the instruments.
That's what I was trying to tell us. What does it mean when the two lines cross? That's what I was trying to ask you.
Yeah, well, it's the 2 years the most money-like of the instruments. What are we trying to project for the 2-year rate in the future? It's very similar to Eurodollar futures, right? Because Eurodollar futures are essentially a bet on forward 3-month LIBOR, which 3-month LIBOR has a lot to do with monetary conditions, including monetary policy from the Federal Reserve. So the 3-month LIBOR, Eurodollar futures are projecting kind of what the Fed's going to do based on the market's own methodology, its own factors, whereas the 2-year forward, or the 2-year forward rate is essentially trying to do the same thing, picturing what's money rates and money-like attributes going to be 2 years down the road, considering different criteria, different methods where we're deriving this measure from the yield curve. So we're kind of attacking the same thing that the Eurodollar futures market does, but doing it from a very different angle. But also because there's a 2-year Treasury cash rate, the nominal rate that we see today, there's interesting information when we compare the forward rate to the cash rate, because it tells us what does the world look like today? What does the market think, or the yield curve think about the market or monetary conditions a couple of years down the road? What do these things look like, and when do they actually, how do they interact? What you see is more often than not exactly what you would expect to see, which is the forward rate kind of projects the mainstream view of what the Federal Reserve is going to do or monetary conditions are going to do. So in the current period, this year and in particular, going back to last year, the forward rate began to rise before the 2-year nominal rate did.
Jeff, we'll do some examples. We'll show the graph 2000, 2008, and the present one. What happens when those lines intersect? In your article here, tell me if I've misread it. That's the indication when it seems that it coincides. It doesn't seem. It coincides with a change in monetary policy. Can we imply? Is that what the crossing of these two rates implies?
Yes, it's the market saying that the 2-year Treasury today has gotten here, and if the 2-year forward rate goes above and starts to come down, and then they eventually cross, that's the market saying that we're expecting that's it. Whatever is causing the 2-year cash yield to go up, we're now believing that it's reached its highest point, and more likely than not, the path of least resistance going forward is lower. And so that's, like Eurodollar futures, we have to then interpret what are the factors that are driving the market, in this case, the yield curve, to reinterpret the regime of forward rates going forward. And a lot of it has to do with monetary policies, the Fed, what the Fed believes versus what the market believes the Fed will actually be able to do. And those are two different things through history. So when you look at the historical examples, these two lines cross, it's basically the market becoming more and more sure about its position relative one to the other.
So in 2000, the dot-com bubble, we see the federal funds target as it existed back then versus the corridor now, rising, rate hike, and then it goes flat before eventually, of course, being rate cut. Now we've got an inversion with the 10-year and the 2-year, right, Jeff? Suggesting recession ahead sometime in the future. But the point that you've circled is when we're also visualizing, seeing that there's going to be a change in monetary policy. In this case, from rate hike to pause.
That's, again, the 2-year is all about the moneyness of the 2-year Treasury note. And so it's kind of, again, specifically focused on if monetary policy, if the Fed rate hikes are the biggest contributor to changes in the 2-year yield, then the forward yield is sort of telling us about what that's supposed to be going forward, what the market thinks the Fed's going to be doing going forward. And as you described in 2000, Emil, what happened was the 2-year forward rate fell below the 2-year cash rate just after the final rate hike from the Greenspan's Fed in May of 2000.
Quick question. Did the Greenspan Fed know that this was going to be the final rate hike, or were they under the impression that they were going to continue hiking rates?
You know the answer to that question.
Well,
they're always continuing to. Yes,
okay,
in May of
key.
2000, despite the fact that the economy was weakening, despite the fact that dot-com bubble had started to burst, even though it wasn't as bad as it would get to be, all sorts of negative implications that were being priced in the 10-year Treasury note, they started to get priced into the forward 2-year rate, because the forward 2-year rate started to say Greenspan's Fed's not going to be able to hike rates that much further, and that the path of least resistance is more like the 10-year note, which is recessionary. So the crossing of the 10-year or the 2-year forward to the 2-year nominal was the market saying, okay, we think this is it for rate hikes. And this was a couple weeks after the last rate hike, when the Fed was still relatively hawkish, still believing until late into 2000 and into early 2001 that the labor market was incredibly tight, that inflation pressures were incredibly risky, and the market was saying, no, we're heading toward recession. And as it turned out, that when the 2-year forward rate crossed the 2-year nominal, that was correct. That was the last rate hike, and the Fed, Greenspan Fed, would not hike again.
And if you'll notice, a few months before that, the two rates were essentially effectively equal. So maybe not quite crossing, but just at zero. And it was just this pressure, this tension of the market saying, oh, this is it. There's not much left here. Let's go back in time. But we're going back in time relative to the show, but relative to the graph, we're going forward in time. 2006, Jeff. Is it the same story? The 10-year inverts with the 2-year warning of monetary and economic trouble ahead. And then, for quite a long period of time, we've got our two twos inverted, saying that is it for rate hikes. Again, did Bernanke, did Greenspan, when he was calling him and suggesting to Bernanke what to do, did they know this was the end of the rate hikes? Or would they later be surprised?
No, they were, again, the Fed wanted to continue because they thought, hey, inflation pressures, labor market, unemployment rate, all these other indications. And it was, there's that period before the final rate hike where the market perceives that, okay, this might be the final rate hike. And so the forward rate and the nominal rate sort of track each other very closely until you get to that final part where the 2-year forward rate goes below the nominal, suggesting the market is increasingly sure, if not certain, that the Federal Reserve has reached its point of its terminal rate. It's not necessarily a pivot, but at least rates that are not going to go any higher. And that's really what the two-year spread is telling us. It's not about necessarily that rates are going to go lower, but okay, the market is increasingly sure that we're getting closer to the end, and then we know it's the end when the 2-year forward rate goes below the nominal rate.
And that's where we are in present day, aren't we, Jeff? Just a moment ago, yesterday, the glitterati of the central banking technocracy met at the Hole of Jackson in Wyoming, and they said that they are going to be hiking with abandon, lewdly hiking away, wantonly hiking until inflation is back under control. I'm sighing, raising my eyebrows. So, okay, rate hikes until the eye, as far as the eye can see across the Wyoming plains. Meanwhile, when we look at the fitted instantaneous forward 2 years hence, it is effectively right on the cash 2-year yield, right? It's dead on 1 basis point. What is the difference? Nothing.
It's they're right together, just like in 2006, just like in 2000, where the market is saying, okay, maybe there's another rate hike. Maybe there's another couple rate hikes in there. We're not exactly certain that the Fed is at its peak yet, but it's so close because, as we see, as you look at the forward rate, it's behaved more like the 10-year Treasury than anything in the front end of the curve ever since middle of June, ever since we had a real big breakdown in the global monetary system as well as the economy. And so the reason I brought it up today or this week is because it's right there. And at the point where it actually does cross, that would be the premise of our show here. That would be a warning sign that, okay, the Fed, whether it agrees or not, is likely done with its rate hikes. So the market, because the forward rate and the 2-year nominal rate are right there close to each other, the curve is, you can remember, because this is derived from the entire curve, the entire treasury market is saying, man, the Fed is almost done. It's right there, right near. It's getting really close to where it would be the last rate hike in the cycle.
Jeff, your final point in this article is trying to discern whether present day is going to be more similar to 2000 or 2006. Can you explain to the audience what you're thinking there regarding the timing of either the recession or the pivot towards maybe rate cuts or just pausing the rate hikes? What are you saying at the end?
I think that's that's where we get into, once the 2-year forward rate goes below the 2-year nominal rate, is the amount of inversion, how quickly the market is projecting not just a terminal rate hike at that point. Once they cross, it's not about the terminal, the last rate hike. It's about what comes next. And so I imagine, and it hasn't really happened, but I imagine if the forward two-year rate kind of just snuck a little bit below the nominal, it would mean that, okay, something like early 2019 where the Fed paused, and that it could be able to pause for quite some time. Whereas you get a really steep inversion in the forward rate compared to the cash rate, then it would be more the market saying trouble is really starting to build, where, again, the probabilities are stacking up for rate cuts, not just an end to rate hikes. And so that's kind of the next step once these two cross. And, maybe they don't cross. Maybe things go right. Maybe the Fed is right. And, the rest of this year is much better. But, most of the yield curve, most of the markets are saying that's a very low probability. But at least as far as the 2-year forward rate is concerned, it hasn't reached that point of no return yet. And then once it does, if it does, it's a matter of how steeply it goes underneath the nominal rate, and what that would mean about, the market's perception of rate cuts down the road, and what the rate cuts actually mean as far as monetary and economic conditions.
Jeff, just wanted to thank you on behalf of the audience for introducing this measure to us. It's something that I don't come across in Bloomberg, CNBC, or in the financial media. So it's another arrow in our quiver that we're going to be able to be ahead of the game on. So very much appreciated, Jeff. Thank you.
Very welcome, Emil. Happy to do it.